This content is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional. Okay, let's unpack this. We are diving into a pretty crucial set of sources today, all analyzing the recent market volatility. We're really focusing on the trading action right after that major sell-off, which, happened during a short holiday week. And the core tension here is just, well, you can feel it. We've seen what looks like a relief rally, a nice little bounce. But that move is fighting against these massive kind of invisible macro pressures that caused the sell-off in the first place. So the big question is this bounce for real? Or is it just noise before the next big move? Our mission today is pretty clear. We're going to extract the technical truth looking at price, momentum, and volume. And then we're going to connect it to something I think 95% of investors just completely miss, the real global reason for why liquidity is tightening up.
What's fascinating here is you have all these different sources, but they're all leading to, well, pretty much the same conclusion. On one hand, we have these really specific technical charts for the SPY for stocks like Meta and Google, very micro. But then you pull back, and the high-level macro commentary points to a single external driver for all of it.
The true catalyst.
Exactly. So our goal is to synthesize all of this. We want to lock in the clear technical levels to watch for confirmation one way or the other. And more importantly, we want to really understand this global liquidity issue because that could honestly dictate the market's path for the rest of the year.
Okay, so let's start with that technical snapshot. It was a weird week, a short trading week, right? Close Thursday, early close Friday.
Yeah, very truncated.
And that created this kind of anomaly where early in the week, advancing stocks were just crushing declining stocks. I think I saw a 6-to-1 ratio at one point.
Right. And on the surface, that looks like a powerful reversal.
It does.
But you have to treat it as deeply suspicious. This turnaround is happening on extremely low volume.
And for anyone listening, let's just hammer this point home. Why does low volume matter so much right now?
Because the institutions, the so-called smart money, they use volume as their confirmation.
Okay.
When an index or a stock goes up on low volume, it's a huge signal that they are not participating. They're on the sidelines.
So they see it as a potential trap.
A potential trap, exactly. It's a move that could just completely reverse once real liquidity, real volume comes back into the market. They don't want to get caught holding the bag.
So if they aren't buying now during this little rally, where were they last week?
They were selling heavily. The sources all highlight what they call a huge red volume node.
A volume node, just meaning a huge spike in selling
A
volume.
massive spike. It dwarfed the volume we'd seen not just in November, but stretching all the way back into October. It's just clear-cut distribution.
So institutional investors were actively dumping their holdings.
Actively. And now we're just seeing a mechanical bounce against that pressure, but without their buying to back it up.
That makes locking in the price levels for the S&P 500 ETF, the STY, absolutely vital then. Let's run through those key numbers. So for a bullish confirmation, what are we looking for?
The market has to close decisively above the 50-day moving average and critically above the $455 price level.
And if it gets above 455 and holds,
Then the door opens for a true bullish stance. You could see a test of highs up near, say, $470.
okay, but what about the downside? If this rally fails,
If it rolls over, a close back under 455 immediately puts $440 in play. But the real line in the sand is $430.
why 430? What makes that level so important?
Because that's the bottom of this recent pullback. If we break below that and, stay below it, we're no longer in a healthy pullback.
It's a trend change.
It's a defined bearish trend. It confirms that all that institutional selling we just talked about was the real deal, the start of something bigger.
And what are the momentum indicators saying right now?
Still firmly bearish, actually, despite the bounce. If you look at the daily mass CD, it's a textbook sell signal. The lines are both sitting below zero. And the RSI, the Relative Strength Index, it's also below the 50 level. For the bulls to really take back control, you need a high volume push that gets the RSI back above 50 on the daily and weekly charts. Right now, it's just not there.
All right, this is where it gets really interesting. Let's connect this technical weakness to the bigger global picture. The sources are arguing that all that selling wasn't just about the Fed or, I don't know, some AI fears. It was driven by an invisible force.
Right, global liquidity tightening in real time. And that invisible force has a name. It's the unwinding of the Japanese yen carry trade.
This is the macro trigger. This is the big one that most people are not watching.
I'd argue is the single most important factor, and almost nobody on Main Street is talking about it.
Okay, so we need to explain this properly. Walk us through it. What is the yen carry trade?
Absolutely. So think of it this way. For decades, really since the 1990s, Japan has had near zero or even negative interest rates.
Right, to fight deflation.
To fight deflation. And this made the Japanese yen, the JPY, the cheapest currency in the world to borrow. So what did global investors do?
They borrowed it.
In massive amounts. Hedge funds, asset managers, everyone. They'd borrow billions of cheap yen, immediately sell it for US dollars, and then invest those dollars in higher-yielding assets.
So U.S. stocks, bonds?
U.S. stocks, corporate bonds, real estate, even crypto. It fueled a massive global asset bubble. Japan was effectively the world's bank.
What's the scale we're talking about here? How much money is tied up in this?
The conservative estimates are somewhere between $7 and $10 trillion globally.
10 trillion. Wow.
And to make it even more connected, Japan became the largest holder of U.S. debt by recycling a lot of this into our treasury bonds.
So the whole system depends on the yen staying cheap. What happens when it doesn't?
That's the unwind. That's what's happening right now. Japan is finally starting to raise its interest rates, and that makes the yen stronger.
Okay, so if you're a fund that borrowed billions of yen,
your loan just got a lot more expensive to pay back. Suddenly you're forced to come up with cash. And where do you get that cash? You sell your most liquid, profitable assets.
which are often high-flying U.S. tech stock.
Exactly. You sell your NVIDIA, you sell your Apple, you sell your Bitcoin to raise U.S. dollars to pay back your now very expensive yen-denominated loan. It's a huge systemic deleveraging event.
Is there any concrete evidence of this happening right now?
Oh, yeah, absolutely. The sources point directly to SoftBank, the giant Japanese firm. They recently sold off a huge chunk of their NVIDIA stake.
And that wasn't seen as them being bearish on AI?
No, not at all. Analysts saw for what it was. A need for immediate dollar liquidity, likely driven by this exact stress from the strengthening yen.
And you can actually see the correlation on the charts, right?
You can. The observation was that when the yen spiked, when it got stronger, the U.S. market sold off sharply. It's a direct link. The currency market in Tokyo is pulling the strings on stock prices in New York.
It's just incredible. So ignoring the USD-JPY pair is basically flying blind right now.
You are missing one of the primary drivers of volatility, without a doubt.
Okay, let's see how these pressures are playing out in some specific stocks. Let's start with Meta.
Meta is a fascinating one. It had that massive rally earlier in the year, but the recent price action has been, let's just say, terrible. It's really struggling. The sources are even suggesting this recent low-volume bounce could be a classic dead cat bounce.
A temporary recovery that's doomed to fail.
Exactly. A bounce without any real institutional support behind it.
So what are the key technical levels for Meta that we need to be watching?
The big one, the psychological level, is $600. That is critical support. If Meta loses $600, the path is pretty clear down to the next support level around $545.
And the upside. What do the bulls need to see?
For the bulls, you need to see a real momentum curl. A push to retest resistance at $636 is possible, maybe even $660. But for, true confirmation that the institutions are back in the game, you need a sustained close above $670. Until then, any move up is suspect.
Okay, let's pivot to Alphabet, to Google, because it sounds like it's telling a completely different story.
A vastly different story. Google is showing incredible strength. It just became the third largest company in the world.
And the fundamentals are just rock solid.
They are. I mean, they reported over $100 billion in revenue in a single quarter. That's a 15% year-over-year increase. And they kept 26% more of it as earnings than last year.
And the sources really honed in on this one metric. Operational efficiency. Wall Street loves this.
Oh, they're obsessed with it. And Google is generating $1.94 million in revenue per employee.
Which is just staggering. How are they doing that?
It's a combination of strategic staff reductions and a much deeper integration of AI into their own operations. They're just becoming leaner and more profitable.
Which gets analysts' attention. I saw Citibank put a price target on it of over $340. Where do they see the growth coming from?
It's really about AI monetization and cloud. Their Gemini AI platform already has 650 million monthly users.
That's a huge number.
It is, but it's important to keep it in perspective. It's still trailing ChatGPT's 700 million weekly users. So there's still a massive runway for growth as they bake Gemini deeper into search and their ad products.
So the strong fundamentals provide a buffer against all this macro chaos.
A critical buffer, yeah.
Okay, let's pull all of this together. We've got a bearish technical picture, serious macro stress, but then these pockets of real strength. What are the main takeaways for an investor right now?
The number one takeaway is to be extremely cautious of this low-volume rally. It lacks conviction. We have to wait for next week's volume to see if the institutions show up.
So don't chase this move.
Do not chase rallies on low volume. It's a classic mistake. Wait for confirmation.
And since we're heading into December, we have to talk about the Santa rally myth.
Ah, yes, the headlines are coming.
They are, but the sources had a really good clarification on what it actually is.
They did. The true Santa Claus rally isn't the entire month of December. Historically, it's a low-volume drift higher during the last 5 trading days of December and the first 2 of January.
It's a very specific, narrow window.
Very specific. It has to do with end-of-year tax loss harvesting and early-year allocations. It is not a guarantee that the whole month will be a bull run. Managing that expectation is key.
And for long-term positioning.
This is where you get strategic. When you see quality companies like a Google that are 10–20% off their highs, that's correction territory. That is the time to be dollar cost averaging into your positions.
Use these dips as opportunities.
Use the fear in the dips as your entry points into fundamentally sound businesses.
And finally, let's touch on that fascinating trend with crypto ETFs and wealth strategies. This goes way beyond just buying Bitcoin.
It really does. What we're seeing is high net worth investors looking at these ETFs, like IBIT or others, not just for the price appreciation.
So what's the angle?
It's about sophisticated wealth management. It's about liquidity and taxes.
Okay, explain that mechanism.
So if an investor holds one of these ETFs inside a tax-advantaged account, like a Roth IRA, they can actually borrow against the value of those shares.
Without selling them.
Without selling them. And here's the crucial part. A loan taken against an asset inside an IRA is a non-taxable event.
So you can pull cash out for, say, a real estate purchase or another investment without triggering any capital gains tax.
Exactly. It's using the asset not just for growth, but as tax-efficient collateral. It's a wealth-building strategy the rich have used with stocks for years, and now they're applying it to digital assets. So to synthesize all of this, the market is still in a very precarious technical spot. We have bearish momentum signals, key price levels that have to be proven, and all of that is being amplified by this massive global macro pressure from the yen carry trade unwind.
Right.
The short-term bounce is nice, it provides some relief, but you have to view it with deep skepticism until high volume comes in and confirms it, pushing the SPY back above a level like $455.
So we've clearly established that the market's recent moves are deeply connected to global liquidity, specifically through the Japanese yen, which leads to the final question to think about. If you only track the daily price of the U.S. market and you ignore what's happening in global currencies and bonds, how much predictive power, how much defensive insight are you truly missing out on? Thanks for listening to the Deep Dive audio view on 15 Minute Investor.